saying I'm Sharon Wilson, publisher and co-owner of Resort Trades Magazine. Welcome to another Trades Lunch Bunch. It's part of our Learning Center initiative to provide the timeshare community with some togetherness, get us a little connectivity. And our speaker today is Bill Ryczek. He's a principal of Colebrook Financial Company, and Colebrook specializes in providing financing for the timeshare industry and can offer a variety of facilities in amounts ranging from $100,000 to $30 million or more. So before we get started, I did want to mention that we've had a lot of great Trades Lunch Bunch events, and I hope if you missed any of them, or even if you wanted to review some of the ones that you've seen or see others, go to Resort Trades channel on YouTube, and while you're there, be sure to subscribe and hit the bell icon to remind yourself whenever there's a session that we mount to chime in, comment, make yourself part of the networking effort that we're trying to undertake here. So you may have seen this month's edition of Resort Trades. She'll get it real quick. But this month was, of course, December 2020. And if so, inside there is an article by Bill on what he is looking at as far as the timeshare industry and financing outlook is. And we're hoping, Bill, that you'll be able to tell us a little bit also about what the future holds as far as you can tell. Put on your crystal ball or whatever it is. So,
but I am going to talk about the reason we're doing it. The reason we're doing it in this format is because we can't get together anymore because there was a pandemic. Although not everyone finds finance quite as fascinating as some of us do, and I've been on some art of finance panels where social distancing would not have been a problem. We could have had people 20 feet apart, and it wouldn't have been. No one would have noticed. Okay, I see we didn't lose anybody, so that's good. We'll keep going. We found. Let me start with the slides here. When this first started, I had said if this would last 3 or 4 months, there could be some serious problems out there. We're now 9 months into it, and not that there aren't problems, but there are not massive bankruptcies, there's not massive defaults. And let me talk a little bit about what we've seen. For us, the keys are, number one, that's by far the most important thing, and really 2 and 3 are subsets of number one. The most important thing for us is the performance of our receivable portfolios. That's very important for most developers as well, because for most developers, the portfolio is their most important asset. And in a lot of situations, certainly in most finance companies, if you don't do new business, you don't generate new business, but your portfolio holds up, you're going to be okay. And that's the difference. You look at what businesses are having trouble in the pandemic, it tends to be retail. If you own a restaurant and no one shows up that day, you have no revenue. If you own a finance company and nothing happens that day, you have a stream of cash flow coming in every day. So it doesn't stop unless something causes it to stop. And that's the concern. Are developers healthy? And more important, are the consumers healthy? Are they going to pay? Because if there is massive unemployment, people can't pay, then we were going to have problems. So let's look at how things have held up. And this, I find a really interesting slide, and this is probably the most important slide that'll be up there. It's the only one with any real data. What we did is we took the cash flow in our portfolios for the 6 months prior to the pandemic, the average cash flow, and what was coming in. And there's a couple of caveats that you have to use. One thing that affects, this is all cash flow. It's not just scheduled monthly payments. It's all cash flow, including prepayments, payoffs. And what we find is that it's affected by prepayments. You have a lot of people who buy timeshare, finance it at 17% with the thought of, I'm going to go home, I'm going to pay it off in 30 days. I'm going to do 30 days, 60 days, same as cash, and pay it off. So, and you generally see a lot of prepayments 30 to 60 days after the sale date. So when we get new receivables coming in, a lot of those receivables pay off fairly quickly. As you're not having any new receivables come in, those payoffs are going to go way down, and payoffs did go way down. So when you see the cash flow dropping, that doesn't necessarily mean that things are bad. It means that you're getting fewer payoffs. Secondly, because not much was coming in, those portfolios were amortizing. Some of those older notes were paying off. So you would expect the portfolio to go down, the cash proceeds to go down over time. And when we saw March and said 96%, we were pretty happy. First thing, well, it's the first month. Who knows what's going to happen. We saw 93% in April. Said this is pretty good because doesn't mean 7% of the people are delinquent. To get 93% of your pre-pandemic cash flow, knowing there can be fewer payoffs and knowing the portfolio is going down, was pretty good. So the bottom line is that our portfolios have held up much better than we thought they would hold up. We went to all of our developers when this happened and told them that they could go out and offer deferrals of up to 90 days to clients who had COVID-related income loss. We didn't want to just do an across-the-board deferral. We wanted people to sign a statement saying they had lost their job or their income was impacted somehow by COVID, and if so, they could get a 90-day deferral of up to 90 days. And we were thinking, if I had to pick a number out of the air, I would have said, 10% of the portfolio may be deferred, because we were expecting a lot of unemployment as part of this. But never was it more than 2 or 3%. And right now it's almost zero. Our developers were they were not doing it across the board. They were pretty selective in who they did to. They talked to the people, found out if they could make payments, and if they really had lost their jobs and didn't have any source of payment, then they deferred them. But try to get them back on track fairly soon. So the deferrals were far less than we ever would have anticipated. And we were very quickly down around the 1% category. So the portfolios have held up much better than we ever thought they would when the pandemic started. And if you said we're going to be down for 9 months, we would have thought that a lot more would have happened. And talk a little bit about our developer health. And later on, we'll get to the consumer metrics as why some of those portfolios have held up. We have developers on recourse, so obviously we're concerned about our developers' health. Keeping the projects up, keeping their operations going, servicing the customers to make sure the customers are going to pay. And we found our developers doing reasonably well. One of the big reasons that our developers have done well is PPP financing. Almost everybody we know has PPP financing because timeshare is a very labor-intensive business. Most of them had large payrolls. They went out and got financing. They got it quickly. Most of it's going to be forgivable. And they're in pretty good shape there. And then the second stage is, how do you reopen? We find right now that the resorts, and it depends upon where. People will say, well, how are your customers doing? Well, it depends on where they are. It really depends upon two things. One is where they are, and two is where their customers are. If you are a drive-to resort where the incidence of disease has been relatively low, chances are you're doing fairly well because your customers are going to be around where you are. If you're a destination resort, say Orlando, Las Vegas, your customers are all over the place. So you're probably not going to get as many of those customers as somebody who has, say, in northern New England. What we're finding is, one is usage and two is sales. Most sales operations are reopened, and I can say at this point that almost every one of our resorts is open. They may not be doing a lot of business, they may not have very high occupancy, but they're open. And as far as sales go, that's a real question. I mean, I don't think when people started a sales operation, you're wearing masks, you're social distancing, you're doing all these things. And logic might dictate that you wouldn't be able to sell anything. But the timeshare business has made a career, has really made their reputation selling things that logic would dictate people won't buy. If you were to say to someone, will people with 750 FICO scores and good income borrow money at 17%? Most people would say, of course they wouldn't. Well, we've got thousands of customers who've done just that because the timeshare people at the point of sale have sold them that. So when you say, would you go out and risk your life in a pandemic to go to a timeshare presentation? Everyone would say, of course not. But there are a lot of people going out there to timeshare presentations. There are not as many, clearly, as there were, and any sales operation is going to be hindered because you have to have social distancing. One of the main ways, we have a lot of developers who do podium presentations. You have a salesperson standing up there giving a presentation to a room full of people. Well, you can't have a room full of people. One, you have to have a lot fewer people, and two, with a lot fewer people, there's a lot less excitement at the podium. You don't get the reaction. So the sales presentation is very different. You have fewer sales, you have different kind of sales. But what we're seeing almost across the board, and my head is blocking that bottom right part of the slide, but we're finding the sales, it says sale, oh, there we go. Thank you, Sharon. And you said you weren't technologically proficient.
Fooled even myself.
Yeah, wonderful job. Sales metrics, the VPG closing percentages are very good. Almost everybody reports doing much better in terms of VPG. So we have fewer customers. They're motivated. If you're going to get out there in a pandemic and you want to travel, you must really like to travel. And if you really like to travel, then you might want to buy some timeshare. So the tour flow is down, sales are up. And one last thing I want to say about resorts has to do with homeowners associations, which is a really key to developer health, and key to portfolio performance, because if the portfolios aren't maintained, you won't have. If the properties aren't maintained, the portfolios won't pay. I think the majority of associations collect their dues once a year, generally around the first of the year, January 1st, February 1st. So they had the lion's share of their payments in before the pandemic hit. When they bill upcoming January, which is about now, bills are going out now, that's going to be a big question. How will the payments come in January and February? How will those associations be able to collect? What you also found with most of the associations is we've seen a change the last 10 years or so, where there's a lot more rental. People went into the timeshare business initially back in 30, 40 years ago because they didn't want to deal with the risk of fluctuating occupancy rates. And now here we are with rentals, HOA and developer rentals. We're back in that game. And in the last 6 months, rentals have been very poor. I mean, they're at best half what they were, and that's best. A lot of occupancy rates in the 15% range, 20% range. So rental income, which the HOAs have come to depend upon, is not there. Some HOAs got PPP financing, so they're doing okay now. But then next year we have to see. If they were depending on developer support and they have a developer subsidy and their developer is having some difficulty, that's going to impact them as well. Now, Sharon always says, make predictions. You write an article, you give a talk, you make predictions. And I know Casey Stengel once said, you should never make predictions, especially about the future. And I've sort of lived by that. And I also have to tell you that, in fairness, before I make any predictions, that when this pandemic hit, people would say, what do you think is going to happen? I said, well, in the short term, we'll get through it. But if this goes on 3 or 4 months, I think there are going to be some tremendous problems. And there haven't been the problems to the degree I thought there would. So take my predictions with a grain of salt. But here's one. The one prediction I will make is that I think in the HOA arena, you're going to see some associations that have been on the brink have troubles. And what that means for some of them is that they're going to find another form of life. That's one thing we've gotten involved in recently. We're financing at this point 4 different repositioning projects where the HOA has decided that they don't have a future as a timeshare resort. They're repositioning as something else. The primary repositioning is condominiums, whole unit condominiums. We're going to dissolve the timeshare regime, take all the units back, sell them as whole units. Another possibility is rental housing. We're going to turn them into apartments. We've seen that as well. And what I think we're going to see There were a number of associations considering changing. They were on the brink, and I think the pandemic is going to put them on the other side of that question, and you're going to see some more repositioning over the next couple of years as associations decide they're not going to be able to make it.
Yeah.
Now, on my final slide is, you don't need to move my head this time, Sharon, it's consumer resilience. And as I see this slide, I realize that I spelled resilience two different ways, and I'm pretty confident one of them is right. I think it's this one. And Sharon, maybe that's another poll question we can add. Do people think resilience?
Maybe one is British and the other's American.
Okay. How many of our viewers think resilience should be spelled with an A, and how many with an E? I think it's an E. But in any event, be it with an E or an A, our consumers have been pretty resilient. The government stimulus programs have been a tremendous aid. A lot of people on unemployment have been getting more money in unemployment than they were when they were working. And it's enabled them to continue to make payments. You see that not just in the timeshare industry, but other portfolios as well. And we talk to our bankers a lot, and our bankers' portfolios have held up better than they thought. Some people are taking deferrals when they may not need a deferral. They're just taking a deferral. But I think payments have held up all across the board much better than people would think. One of the reasons I think that has helped the timeshare portfolios is demographics. One, timeshare owners tend to be a little better income, a little better educated than the average consumer. And what we're finding in this pandemic is there are certain types of jobs that are not being done, and there are other types of jobs that can be done remotely. And if you're a more educated person, the chances are you've got a better chance of being in a job you can do remotely. And I think a number of our obligors and the timeshare notes are working remotely and probably getting paid. They also may have cushions if they're at an upper income level. So between the subsidies, the cushions, the demographics, the consumers have held up well. As we go into another few months, that's a question. Right now I try not to follow the news too closely because it's very annoying and upsetting. But it looks like we are having more problems with another stimulus program. Whether it's going to be $1 trillion or $3 trillion or nothing. I think that would certainly help our consumers if there was something out there, particularly those who could use it. That's going to be the next few months, and that's a prediction I won't make as to what's going to happen with the portfolios. I think if things continue on as they are, and there's another stimulus program, our portfolios will do well. If the pandemic continues on another 6 months and the vaccination process is slow and there's no stimulus program, I think we could see some more problems in the portfolios. So that is pretty much my formal presentation. And Sharon, we're going to move to questions, I think, now.
Yes. And before we do, I did want to point out that we do have your article that appeared in the December issue online. It's posted online so people could find it there. And also we did have a request from Alex Hodges. He wants to hear Cub jokes. I'm sure he will hate me forever for that. Okay. Tim Wilson, co-owner of Resort Trades, asks any signs of new development. I guess it could be an existing resort company.
Very little. We see as far as building, no. But we do see people acquiring inventory. We see people starting up. So we are doing transactions. We've done, I'd say, not as many as we've done in the past, but not that far below it. So we see people doing things. We see people acquiring inventory. We don't see building from the ground up, but we do see a lot of business activity. And that's what's been amazing about this pandemic is the real estate values going up, the stock market going up. It's sort of, I say anybody who would have predicted that would have been people would have been pretty skeptical.
Yeah, it's kind of like the stock market and everything. Dennis Rogers did comment that he was waiting for your first baseball comment. So you didn't have to wait long.
We prepare for these things. I'm thinking about what are people going to ask about portfolios? What are going to people ask about sales and all that? I didn't prepare for baseball, Dennis. So
Next time.
Don't get your hopes up for the Phillies.
Well, and we would like to have you back in a few months and see how things have evolved. Have another question for you. How does the current situation compare to 2008?
It's very different. The reason being that 2008 was a financial crisis, and it affected everything financial, and it was a cause. This has nothing to do with finances. This was a pandemic. The economy was doing very well, and one of the biggest differences has been the availability of financing. I think initially some financiers were a little leery about getting in and how much they should do, but I think at this point, financing is pretty readily available. It's nothing like 2008. In 2008, we were one of only two lenders in the timeshare business who was actively lending. Everybody else shut down. That's not the case now. Some people are more cautious, maybe doing a little less, but there is financing available. And as far as I can see, the securitization markets, you see those releases. I'm not that actively involved in securitizations, but you see releases coming out that securitizations are still happening. That didn't happen at all. And another difference is that rates are extremely low. I mean, rates are, if you have money to invest, rates are almost zero. So that's a tremendous difference. And it's not a financial panic. It's something totally different. So all the elements of financial panic are absent. It's just
knock on wood.
Yeah, it's so far, and I think everybody thinks that interest rates are going to stay low for a very long time. I haven't found anybody say anything otherwise, and most people seem to think the stock market's going to go up. So we don't have financial panic. We have a health crisis.
Yeah, exactly. Well, it's interesting. You mentioned the timeshare ABS market, and we have an article coming out in January, in our January issue, written by Philip Perry, that does a forecast of 2021, and he does mention that they expect the timeshare asset to continue to be strong. So it is interesting.
Yeah, the one thing, I'm certainly not the first person to say this, but assuming there is a vaccination process and the world comes back to some normalcy, I do see a huge increase in travel. And maybe the end of next year.
I can't wait.
Everybody you talk to, myself included, said, I'd go anywhere. I'd even go to Crossville, Tennessee, if that's the only place I can go on vacations here. So, it's. I think that will happen. There's a lot of pent up demand, and people are pretty excited about that. If you just hold out the next few months, that better times should be coming.
Well, Debbie Ellie chimed in and said, "We love Colebrook." She says, "Thank you, Bill, for helping us through the pandemic." And Tim asks, what is a typical interest rate on portfolios today? And are there any investment opportunities available? Any place to park some money?
Well, before we take Tim's question, I can comment on Debbie without betraying any confidentiality. I think that her business has done incredibly well during the pandemic. One reason being it's mostly online. It's not done in person. It does financing. And those businesses have been doing very well. And that speaks to people. You think people would be very hesitant to enter into anything, but she's done extremely well, for which we're very, very grateful and happy for her. Now, Tim's question is, what are interest rates, consumer rates? I said consumer rates on timeshare financing has not changed since the Carter administration. 16, 17, 18%, it's the same. They're selling monthly payment. It doesn't matter where interest rates go, timeshare interest rates stay the same. As far as where's the park money, I'm not an investment advisor. I don't, and if I knew, I would be there. there's it's a very interesting time to have any liquid assets because there's fixed income is nothing. And that's why the cost of funds is so low. And the cost of getting anything in your funds is so low. So I don't have any advice for Tim to what he should do with as many millions of dollars.
Right.
Maybe you should buy. Maybe you should buy. There's no money to be made in investment. Buy something nice for your wife, Tim.
Yeah, I like that attitude. We have another question. You mentioned new sales have continued, but how far down are they from pre-pandemic numbers?
It varies upon where you are, but if you're doing half what you were doing, and we have one or two people who are doing what they were doing before, but that's a rare exception. I'd say if you're doing half what you were doing before, you're probably doing well. We see some that are, and everybody who's open is doing something. But I'd say there's only one I can think of that's doing pretty much the post-pre-pandemic levels, and others are getting close. But I say if you do half what you were doing before, that's not bad.
No, that's a good sign. So what's the key to, I did want to see if you had anything to add on foreseeing, what do you foresee in 2021? I think you touched on it by saying you don't want to touch on it.
Well, I think everything that I feel comfortable saying, I've said. If I could predict the future with great certainty, I would be living my life much differently.
No. What's the key to the continuing health of your business?
Well, as I said before, it's the portfolio's holding up. If the customers continue to pay, our business will hold up. We have a fairly low overhead, so if we don't do new business, we make a little less money, but we don't have any concerns about continuity. And certainly the continuity of our funding sources. Our bankers have been very supportive during this. That's one thing you always worry about when something happens is that people are going to pull the plug and panic, which is what happened in 2008. And that has not been the case. Our bankers have been very supportive of us. We've had no issues accessing capital. That's, and for us, it's getting money, putting money out, and getting money back. It's just transports. It's getting money as our financing sources, putting money out as our developer clients, and getting it back as the consumers. So these are the three-legged stool as to the success of our business.
Yeah, well, I certainly hope that continues to hold up and that you can park your money on your wife's side of the garage. How did the first 7 months of the pandemic compare to what you anticipated in March?
Well, as I said, I expected if we were going to be in it for this long, it would be much worse. When every month when the cash flow started to come in, we sort of hold our breath, especially the first month, and what's going to happen? Are people going to keep paying? Are they not going to keep paying? And every month was a good feeling. Well, we made it another month. Collection is still holding up. Delinquencies are down, no greater than usual. So I think it's done much better than I would have expected. And, again, that doesn't mean it's going to happen. What's going to happen in the next 6 months is going to mirror the last 7 months. But, we hope so. And it could.
Yeah. Ron Roberts had an interesting question. He says, is COVID going to create higher maintenance fee defaults?
I think it will. That's what we talked about earlier with the health of the HOAs. I think that the collections in this year will be more challenging than collections last year before the pandemic. And I think maybe a bigger problem for the HOAs is going to be the lack of rental income they had the last 9 months. So many HOAs now, if they've got a lot of inventory, unsold inventory, are relying on rental income, and that just hasn't been there.
Well, sad to see, really. I believe that if there aren't any other questions, that kind of brings us to the end of our session with Bill today. I did want to say, if you have an opportunity to review this or an interest in viewing other videos from past presentations on our YouTube channel for Resort Trades, please subscribe, hit the bell icon so you'll get reminders when we post another video, and that way we can keep our community networking together, even though it's not exactly what we're accustomed to. Bill, thank you so much for sharing your insights. Bill is always a go-to resource for resort trades, because he will willingly come up and spend copious amounts of time, I'm sure, on writing articles, and always has very keen insight. So thank you, Bill.
Well, thanks for having me. You know, we don't dress up in the office very often. The last time I had this jacket on, I realized it must have been an ARTA event, because I have my ARTA name tag here, so I was going to put it on so I feel like I was at a conference. I hope to see you at ARTA next year. I hope we'll be getting together at some point, and those of you out in the audience, I hope to see you there as well, and wish you all the best, and thank you for watching us.
Yes, indeed. And next Friday, December 18 at 1 o'clock Eastern, we're looking forward to interviewing Lisa Ann Schreier. She has been somewhat controversial from time to time in our industry, because some initial perceptions that were presented when she first came on the scene. But she is laying claim to being the timeshare crusader. So stay tuned and go to resorttrades.com/learning center to view upcoming events. And also, don't forget to comment and be an influencer on YouTube. We sure appreciate your being with us. And Bill, thank you again. Everybody have a great weekend.
Thank you.